Hello and welcome to our conversation on accounting. In this session, we will try to understand and reflect on some accounting terms and their relationship. And in the process, we'll also see the effect of those transactions on the financial statements, balance sheet, income statement, and cash flow statement. So the objective is to see certain common popular financial items and the relationship between those financial items from the point of view of the financial statements. The first one is a cash payment. Whenever you see a company making payment, the payment may be because of expenses, because the company is incurring some expense. Or the company may make the payment in order to acquire asset. Or the payment may lead to reduction in liability. Or payment may lead to the reduction in equity. So therefore, cash payment by a company may be an expense, maybe for acquisition of asset, maybe for reduction of liability, or maybe may lead to reduction of equity. For example, rent paid is an expense, is a payment and is an expense. Whereas plant purchase is a cash payment, and it's an acquisition of asset. Repayment of loan is a cash payment and is a reduction of liability. Distribution of dividend is a cash payment and reduction in equity. So let us see how that happens in a financial statements. To explain this, I have an opening balance sheet which has some assets and the corresponding sources. The financial statements are the balance sheet, income statement, and cash flow. Rent paid 5,000. So rent paid is a cash outflow, and the company is having cash for 430,000, and company paid cash for rent. Company paid cash for rent, and rent is an outflow of cash, and rent is an expense. Rent is an expense. So therefore, this is a payment which has resulted in out of cash, no doubt, but it is an expense. Purchase plant for cash 50,000. Purchase plant. So this is another transaction which has resulted in cash outflow to the extent of 50,000, cash outflow of 50,000. And this is not an expense. Okay, this is not an expense, but acquisition of an asset. An asset will appear on the balance sheet. Repaid loan 60,000. The company is having a loan 100,000 and a repaid loan. Okay, so it is a cash outflow, it's a payment, repaid loan, but it is not an expense, not an acquisition of asset, but reduction in liability. Reduction in liability. Buyback of shares of 10,000. So it is again a payment, cash outflow, buyback of shares 10,000, which is not an expense, not a reduction of assets, but reduction of capital or reduction of equity. So we can see that the expenses or acquisition of asset or repayment of loan or reduction of equity may all lead to the cash outflow. There is also dividend payment, okay? So it's a distribution of dividend, okay? So distribution of dividend is 25,000, which is a reduction of the retained profit, okay? Reduction of retained profit. So therefore, in this example, we have seen how the payments of a company may be towards expense, acquisition of asset, reduction of liability, or reduction of equity. Though in principle, this is not completed, all financial transactions, but if you want, we can also close the financial statement. Now, since there is no income, there is a loss of 5,000, okay? There's a loss of 5,000, and the loss will reduce the equity, okay, or retained profit, okay? There's a cash available is 430,000, and cash payments, so therefore cash available is equal to 430 minus all the payments that the company made during this period. All the payments that, so cash available now is 280,000. So no change in the rent payable. So therefore, the sources side of the balance sheet will be 200. The sources side of the balance sheet will be, okay, so 90 capital, no, so plus the original capital stays, right? 290, we can see that. Capital, distribution of, yeah. Okay, so the capital has come down because of the buyback of shares, 150, no change in the stock. So therefore, the assets should be equal to 450. So at any point of time, if you want, we can also close the financial statement. But the focus of this particular exercise was to show the impact of the expenses and different types of payments. So the payment may result in expense, payment may result in acquisition of asset, payment may result in reduction of liability, payment may result in distribution of dividend, payment may result in buyback of shares. So that was the first relationship. The second item will take cash receipts. There we saw cash payments. Now we'll see cash receipts. The company may receive cash, maybe because it's an income, maybe because it's the sale of assets. They sold some old assets, or maybe the company might have borrowed money and increase in liability, or the company might have raised capital, so therefore it's an increase in equity. So the receipt may result in income or sale of asset, reduction of asset, or creation of a new liability, or increase in equity. For example, sold goods for cash is an income. Sold plant for cash is a sale of an asset. Availed loan from SBI is a creation of a liability, and raised capital by issuing share is an increase in equity. So once again, let us go to the Excel to see this exercise. So sold all goods for cash, 50,000, okay? Sold all goods for cash, 50,000 is an income. Is an income, right? So that will be, let us see whether we have goods. Yes. So therefore, sales, it will be an income, 200,000 and you have received cash for it. So sales is 200,000. So this is an inflow or a receipt, but an income. And whenever we know that, whenever there is an income, there has to be cost of goods sold, okay? And the cost of goods sold will make the stock zero because entire stock is sold. Sold old plant for 100,000. So once again, plant, I sold plant. So the old plant for 100,000. And what is the cost of that? The cost of that is equal to, so sale of plant. So sale of plant is 100,000. What is the cost of the plant? The cost of the plant sold is 100,000. So no profit has been sold at no profit, no loss. So avail a loan of 50,000. So therefore we took another loan for the business and that is 50,000. It's a cash receipt, but not an income, but a liability. Not an income, but a liability. Okay, so we have seen that some assets, some receipts are incomes, some receipts are reduction of asset, some receipts are liabilities, and some receipts are equity. The fourth one, we have raised capital. So capital has been raised to the extent of 80,000. So capital will increase by 80,000. So we see here, there are different types of receipts, but all receipts are not income. Some are incomes, some are liabilities, some are equity, some are reduction of assets. Once again, though all transactions are not given, but still we can prepare the income statement, we can close the balance sheet, we can find cash in hand, we can find profit, okay? So therefore, in this case, profit is 300,000 minus 220. We are ignoring all other transactions. So therefore, just for the sake of example, completion of this example, so the entire profit is transferred to the retained profit. Let us find cash in hand. Cash in hand is equal to cash available. Cash in hand is equal to cash available, and there is no payment. So cash available is equal to cash 760 minus 0, and cash in hand will become 760 an asset. Okay, and no change in the rent table, that stays as it is. So this total sources are 810. 810, we have taken a loan of 50, right? Yes, loan of 50,000. 760, and the sources are equal to assets. Sources are equal. So this concept that when you close the balance sheet, A should be equal to E plus L. A should be equal to sources. That is definitely going to be there. So the focus of this particular part of the exercise is to show different types of receipts. In the previous one, we saw different types of payments. In this example, we are seeing different types of receipts. So to recap, so the receipt may be an income, maybe sale of an asset, maybe an increase in liability, or maybe an increase in equity. So now let us see expenses. If the focus is on expense, think about an expense for a company. So therefore, when a company incurs an expense, so they may pay money immediately. So then it's called cash reduction. They say that, no, we'll pay later. It's a creation of a liability. Or they can issue shares. So it may lead to increase in equity. Or they may give some other assets from the balance sheet. So it may decrease in other assets. So expenses may result in a reduction of cash, creation of liability, increase in equity, or reduction of any other asset. For example, paid salary is a reduction of cash and expense. Salary due but not paid is an expense, but a payable has been created. Bonus to the employees paid by issuing shares. So therefore, bonus is an expense, but we are not giving cash. We're not going to create a liability, but we are issuing shares. So that leads to increase in equity. Paid consulting fee, which is an expense, by transferring some shares held by the company. So an expense resulted in decrease in other assets. Okay. So let us see the same, another example. So again, we have an opening balance sheet and the company, here we are going to see some expenses. So salary paid 50,000, okay? Paid salaries. So salary is an expense and salary is an expense. How much? Salary we paid 50,000, okay? Salary paid 50,000. So it's an expense. It's an expense and you paid money for that. So it's an expense resulting in outflow of cash. Salary due but not paid, okay? Salary due but not paid. So salary due but not paid 25,000. So therefore, in this case, we are not creating any payment, but a liability called salary payable. Salary payable will appear on the balance sheet. You see this? So therefore, this is an expense where there is no payment, but a liability has been created. Bonus to the employees. Bonus is an expense, but the company did not pay the cash, but said we are going to give you shares to that extent. So no liability, no cash outflow, but the capital will increase by 75,000. And consulting fee is an expense, 25,000, but no payment, no liability creation, no capital creation, but an exchange, okay? But the old asset which was there has been paid off to that consultant. So therefore here, the focus is all expenses. This expense resulted in outflow of cash. This salary resulted in liability. This bonus resulted in increase in the capital, and the consulting fee is an expense resulted in outflow of shares held by the company. So therefore, again, an expense may result in outflow of cash or increase in liability or increase in equity or decrease in other assets, okay? So just like any other previous examples, let us close the balance sheet. So therefore, we have no incomes. There is no income. So only expenses. So there is a loss, okay? There is no income. So there is loss here, 175. So what happened to the retained profit? The retained profit has become negative. Observe this, okay? There is no cash receipts during the period except the opening cash, and the payment is only 5,000 or 50,000. So therefore, cash in hand is on to 50,000. Cash in hand to 50,000. And no change in the rent payable. So the sources are equal to 475. No change in the stock, no change in the plant. So the total of the sources should be equal to the assets. So but the focus here is the um, expenses. The focus here was about the receipts. The focus here was on the receipts. The focus here was on the payments, okay? The focus was on the payment. So the objective was to show the relationship between various items, that is the cash receipts, cash payments, expenses. And the last one is the acquisition of asset. When a company acquires assets, okay, or a company can acquire asset by paying cash immediately, or by saying that I'm going to pay later, so increase in liability. An acquisition can happen by issuing shares, so increase in equity, or exchange, decrease in other assets. So therefore, purchase plant for cash is a cash reduction. Purchase plant on credit is a creation of a liability. Purchase a plant by availing a loan is a liability increase. Purchase plant by issuing shares. So it's an acquisition of asset, an increase in equity. Purchase plant in exchange of old asset is a decrease in other assets. Okay, so let us take the final example. So in this example, once again, you have an opening balance sheet and there are certain purchases. Purchase plant 1 for 50,000. So acquisition of an asset, plant 1, and plant 1 is 50,000. But how did the company buy? The company purchased it by paying cash. Do you have that much of cash? Answer is yes. So the company purchased the plant by paying cash, but availed a loan to buy a 75,000 worth of plant. So they purchased, first they took a loan, okay? Loan 75,000 and acquired a new plant 2, okay? Acquired new plant, that is plant 2, okay? So acquisition of plant, the first one resulted in outflow of cash. Acquisition of plant, the second one resulted in a liability. Acquisition of plant 3, acquisition of plant 3 has resulted in a equity, they issued shares. The acquisition of plant increased by issuing shares, okay? How much the company issued shares? To the extent of 100,000. So therefore, the plant has increased by 100,000. But this 100,000, no outflow of cash, no creation of liability, but creation of equity. And the last one is a plant 4. So plant 4 purchased by exchanging shares of M Limited. You see this? There was an shares of 30. So you purchased 30,000. You purchased 30,000 worth of another plant, but you did not pay money for that. You reduced or transferred the existing shares. So in this case, the focus was on acquisition of assets. Some assets acquisition resulted in outflow of cash. Some asset resulted in creation of liability. Some asset resulted in reduction of other assets. And the final one is a acquisition of asset by issuing shares. And just like any other previous examples, no profit, no loss, okay, because I'm assuming no other transaction except these four. And so therefore, the retained profit is not going to change. Cash in hand will be cash available minus cash payments, and cash in hand will now reduce to 350. No change in the rent payable. Okay, that we did not pay that money. So the summation of sources is equal to the summation of sources is equal to 725,000, and the summation of assets will also, okay, no change in the garments. So summation of assets should also be 725,000. So the objective of this session is to understand some relationship between various financial items like acquisition of asset, like expenses, the receipts, and payment. And that is why I say some accounting terms and the relationship. And the relationship becomes very clear in the financial statements, okay? The financial statements of balance sheet, income statement, and cash flow statement. The first one was to observe the payments and see the effect on the financial statement. The second one was to observe the receipts and see the effect on the financial statement. The third one is to see the expenses and the impact on the relevant financial statement. And fourth one is on the assets, acquisition of asset, and the impact direct on the date of the transaction, the impact on the financial statements. Okay, thank you.